All right, so this is our first market outlook video that we've done in now 2 weeks. It was 2 weeks ago today that we did our last video, and things are okay for a day, that Tuesday the 23rd, but then not so good after that. So, but I'm back now. I'm finally back after 2 weeks there in Ghana, Africa. We got back Friday night, so we were here all weekend, and now I'm back with school coming back here pretty soon. Brandon's obviously out of town, but hopefully the market doesn't behave as poorly as whenever I'm out of town. But so far today, not so good, and Friday not so good either. So maybe we can introduce a Van Z vacation indicator as well, as pretty much neither one of it. The market's hasn't been doing well for either one of us being gone. I'm going to break down what's going on here today and some indicators. We were expecting some weakness. We were already starting to see it in the Nasdaq 100 before I left. So we were expecting some weakness, and we were talking about what would be the difference between a pullback and what ultimately may be a correction. Well, today we're starting to see some of those indications to help us know which one we should expect. So I'm going to talk about what we're seeing and some of those indicators, what's driving this price action up, especially the past couple of days, Friday of last week, and then today. And then we'll talk about our trade idea, a stock that just has barely started to participate in the weakness as it heads into its earnings announcement. We'll talk about how to trade that. So let's go ahead and get started. Today is Monday, August the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades. We close out quite a few trades from the past couple of weeks today. We also put on today's trade before the market closed. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who click on those day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So you can see my last day that I last did a market outlook was here, and everything was fine. Light green shading, green line, intermediate line was down, but still in bullish territory. But we talked about the potential, as I left, we talked about the potential for a bearish near-term peak, right? That was 1 day with the near-term line, or this would have been 1 day with the near-term line coming out of bullish territory. Bearish territory, see up from below 40 up here, you would have needed to get above 80 on that second day, and it didn't, right? It dropped back down, and then again we had the same thing happen here, and again we failed to get above 80. So we followed up this bearish near-term peak with a bearish near-term low point, and then multiple bearish near-term peaks, and another bearish near-term low, and a bearish near-term low right now. In fact, we are the lowest we're below the 5% mark, which is an extreme. That's an extreme level. We don't typically get 5% below. You can see during that whole decline we had back over here last summer, we never did get more than 5% below. In fact, the only time we've ever gotten more than 5% below, last time we got on the initial drop was in early 2022. Remember, we talked about a lot of analogs to late 2021 that we've seen here. And here's another analog to early 2022, a significant decline where we dropped more than 5%. You can see otherwise we don't really drop more than 5% below. Over here you can see we got close, we never did drop below that. COVID we did. We didn't do it in any of these other instances. So you can see it's pretty much just these intermediate declines, corrections. The initial drops on these corrections is where we get these kind of drops. So dropping more than 5% below, again, is a sign that this could be more than just a typical pullback, right? When you're just having a typical pullback like we did here in April, like we did last summer, you notice maybe we get more than 2.5% below, but we don't get this far. This is the furthest. Near-term line crossed back below the intermediate line on Friday, and obviously is down there again today. Not as low as you'd expect considering the move, but remember, most of the move occurred pre-market, most of the decline, so you had a pretty significant gap there. We'll take a look at that gap a little bit more here in a minute. Dark pink shading and a red line now, so you are definitely in intermediate decline. The NASDAQ 100 had been already, remember, it got the bull tag before I left, so we had the bull tag. We had bounced up a little bit that day, but again, the potential for we had to bounce up. We did have the first day out. Well, excuse me, no, we did. We were just barely below 40. I think we were at on this day 40.2. And then we moved up to 68 and formed a bearish peak. Been dark pink shading and a red line a lot longer. In fact, we got a cluster on Friday. Continued lower than intermediate lines in the reversal zone. You're just not that bullish. And again, we are nearly 9% below the 30-day moving average. Which, again, if you had to go back how long it's been since we've been this far below, you can see it goes back to early 2022 and COVID and some of these other correction moves that we get this far, drop this much. We talked about this before on the zigzag, right, where we say, okay, if we get a nice 5% drop, then most likely it's going to be a pullback and we move up higher. If it starts to get closer to 10, plus or minus a point or two, then now the odds of a pullback bounce failing start to increase, and that appears to be the case now, because that's how corrections form. Corrections form with, if you were to go back to this one, they form with a pullback that is a little bit bigger than normal. And then we fail on the bounce. We fail on the bounce back up. We do get a 5% move higher. So we will get a 5% move higher here, at least, off of whenever we set the low point here. But if it fails, then we're set up for, and you can see we had one there too with COVID. And then we had one here in 2018, right? We dropped about 10%. We rallied up 6.5%. It failed. And then we ended up dropping a lot more. So that's the idea. We're now down close to that 10% mark. And, we will get a 5% rally. We'll fill in these gaps, and that will happen. The question is whether or not it will fail. And the odds of it failing are increasing. As you can see, this is more of a significant pullback already than what we've seen pretty much since early 2022, since our last correction. So on Friday, we finally got a bull tag on the Dow Jones. So the Dow Jones has been outperforming. It finally got a bull tag on Friday, whereas remember the NASDAQ was a lot earlier. Now we got a bearish, and today is the first day of the intermediate lines cross below market sentiment. So just like that, you can see how things have changed dramatically for the Dow Jones, and for that matter as well, for the Russell 2000. The Russell 2000 was actually holding up pretty nicely. It finally got the bull tag on Friday, dark pink shading or light pink shading in the yellow line, and then of course the big drop today, suggesting this bull tag will be the start of a new intermediate decline. You can see the intermediate line also for the Russell crossing out of bullish territory and crossing below that long-term market sentiment line. Let's take a look at the weekly chart and see what it's doing. As you can see, we are well below. We had the red arrow last week. We are now well below the 10-week moving average, which is falling. You can see this is the biggest weekly Hakinyashi candle since 2022. So we haven't got a Hakinyashi close yet below the 40-week exponential moving average, but you can see how close we are. The NASDAQ 100 looks very similar. Right, this again, we have so far closed this week, only one day, right? But so far we are closing with the Hakinyashi close below the 40-week exponential. And again, the biggest, this is one of your biggest size candles that we've had here. You can see, again, going back to early 2022, COVID, 2015 when we started that correction. So this is a very significant size candle. When you look at the whole moving average, because we like to look at that one as well, and you can see, it hasn't even turned red yet. The 20-day, the 200-day has not turned red yet. You can see we actually did flip the parabolic SAR on Thursday last week, only to have it come right back down on Friday. Remember, this is a Hakinyashi candle on Friday, and again, this is the size of the daily candle, which you can see. Today's daily candle is one of your biggest Hakinyashi bodies that we've seen again since 2022 or COVID, right, or 2018. This is a pretty dramatic size candle here. And then when you look at the weekly version of this, you can see how the 20-week has changed. The parallel box SAR has changed. We are pretty significantly lower after getting that transition candle. This is the week that I left. So the 2 weeks that I'm gone, we have a couple bearish weeks, and then now this one again with a pretty decent sized candle down here, and your PPO is falling like a rock. With significant momentum again that we haven't seen for a long time. I mean, again, since early 2022, we haven't seen this much bearish momentum here. Now let's take a look at the 3 green arrow chart. Remember, the S&P has been flirting with 3 red arrows. The Nasdaq is the earliest one to go 3 red arrows. The Dow and the Russell have just barely turned 3 red arrows. But they followed up those 3 red arrow signals on Friday with a significant move lower today. MACD. I mean, we're not going to get 3 greens anytime soon on any of these indexes with how far below their moving averages they are. You can see we are well below the 50. We are flirting now with the 200-day moving average. You see how much the MACD has dropped down, some pretty low levels, a lot of volume today. We'll take a look at that here in just a second. So that's the S&P. The Qs flirted with the 200-day today before coming back up. It's now below the point of control in the past year. Again, a lot of negative momentum. You can see the volume picking up down there. If I look at some of these other oscillators, like the DMI for the S&P 500, pretty clear bearish pattern, right? You can see we haven't had a move above 40 on the DMI for a while. In fact, this is the high. I mean, you have to go back to early 22 to get a move this bearish on the negative DMI indicator, and for that matter, as bearish on the positive DMI. It's one of our lower levels here. So you can see the ADX was already pretty high because we were so bullish. It was already pretty high. It never did drop below 20 or even below 25. So we went from dark green shading straight to dark pink shading. And that hasn't happened very often. You can see it happen right there in 2020 and happened a little bit over here in 2018 as well. 2017 into 2018. It happened there too. So it's not common for that pattern to happen. If I take a look at the RSI and the CCI, obviously the RSI is now below 40. So we can actually start the red box here. So I'm just going to move this over here. We can start that red box. Whoops. There we go. We can start a red box there. You can see the CCI had already dropped below 150 last week, or the first week I was gone, below 200, excuse me. It's way dropped below 200 again. Now, remember the key here is for the weekly to drop below minus 100, which it's doing now this week. So we can now move this, let's edit this and move it all the way into this last week. So we'll go right into here because now we can see we do not have green shading anymore because the weekly CCI has dropped below minus 100. Again, this is another sign that we are now in a potential correction mode, because that's generally when it crosses below minus 100. Remember, 2023, we were pretty darn close to a correction. Remember, the Russell 2000 did go in the correction. So the fact that once you cross below minus 100 level, it's typically it's a bigger deal than just a normal little tiny pullback, as you see, as you had one right here in early 2023, 2024, that little pullback, and then again, this was a correction, and this was a more of a significant pullback. One of your bigger pullbacks that we've seen. Let's go to the Ichimoku cloud. We are below the cloud, so this is the first day, right, that we're below the cloud. That's a significant change in trend. We obviously have a significantly bearish rate of change over the last 26 days, and we are of an intermediate trend strength on a bearish trend, right? We're below -2 and above 65, so we have flipped to the intermediate side. The Qs have a mature bearish trend. We are below -5 and above 80, so but this is the first day that we're really clearly below the cloud. And you can see the cloud has turned pink, plotted 26 days forward over there. Let's take a look now at the Bollinger Bands. Well, this is the first day that we dropped below the lower band. We also are well below the lower Keltner channel. As you can see, the first day we've dropped below both, and you can see that momentum down there at the bottom. This is one of your bigger momentum moves that we've seen again since. You have to, you can repeat with me all the way back to early 2022. Very significant. We had dropped below bands and Keltner channels there as well, as you can see. If I were to, we dropped below that lower band over here, but not necessarily below the Keltner channel. There's been other times that we've dropped below lower bands during intermediate declines, but this is one of your bigger moves that we've seen with the bandwidth. Remember, the bandwidth is actually lagging, so if it's already here now, then this bandwidth is really going to move up pretty significantly again. Generally doesn't do that. It did it over here on the rebound, and you can see in early 22, you can see how big the bandwidth got. If you follow my cursor all the way to the right, that's probably where, or somewhere close to where, this one's going to end up being too. So again, bigger than your typical intermediate decline, whereas 2022 was full of correction moves during a correction. It appears that this move will end up being something similar. Let's take a look at the intraday chart. Obviously, you had a lower high and a lower low. You closed well below Friday's low, which was last week's low. You can see the Arun indicator had turned bearish like the day after I left. The day after I left, you got the bearish signal there. You were barely below 70 on that particular day, and you crossed up to 100 on there. But look at the size here. Look at the again, this is the size of this channel rose. If you recall, we talked about this because it's rare for it to increase like that on a bullish move. Well, here it is increasing to that degree with a bearish move here. And again, early 2022 was the last time we had this size, this big jump in the size of the 4-week range in such a short amount of time. Obviously, today's volume and trading range were significantly higher, and that doesn't even include the gap, right? So it's a 13-point move, not including the gap. If I were to add the gap, 532.9, and the high is 523. So you're looking at, let's see here, 532.9 minus a high point here at 523.58. So you add on another 9.32 points to the 13.31 range. So we had a 22-point range on the S&P if you include the overnight trading. 22.63 point range, well above the average. Now, again, that doesn't get included in the ATR. It kind of does. The ATR kind of accounts for that, and that's why you've seen such a big spike, huge spike over the past few days, well above the 1.5 level up to 1.7. And again, that's typical for pullbacks that are bigger, right? We didn't have that size move until early 2022 when we eventually got up to above 2% on the relative ATR. That appears to be the case now, and volumes are just starting to pick up. The ATR has picked up pretty dramatically, but the volumes, and for that matter volatility, are just starting to pick up. Here's another sign that we may be in a correction. We have closed above 100%. Remember, we never closed above 100% in 2022. In fact, I posted this tweet. Here, let me get this tweet over here. I posted this tweet about the VIX being above the 110% mark, so it ended up closing above 115%, right? Just barely. Let's see here. Let's see exactly where it closed. Closed at 114%, so just barely under the 115% mark, but definitely above 110. And so I tweeted out that these are all the other instances that we closed above 110% on the way up, right? The last time we closed above 110% was on April 1st, but the VIX was coming down by then. So this was the first time since February of 2020 that the VIX has closed above 110% relative to the VIX 3M on the way up since then. So, but again, here's all the other instances that we closed above 110% on the way up, and they've all generally been either very, very short-term moves or the beginning of a correction, or in the case of early 2018, about as deep a pullback as you can get without being a correction. So very significant moves. So there's another sign. You can also see too that the VIX, remember, is well above its 200-day moving average, well above. And we talked about how important, when the VIX gets above the 200-day moving average, it's pretty significant. In fact, your 50-day average is now crossing above the 200 on the VIX. But if you look at the weekly chart for this week, so last week we closed above the 200-week moving average, and this week obviously we're clearly above that. When you get above the 200-week moving average, you tend to get a regime change. I've always called them a regime change. Last time we had a break like that was early 2023 on the banking crisis. You can see we've had much bigger moves the past few weeks in volatility, and this is only one day this week, so things can change. But that's a pretty significant move. Again, a lot of momentum in the last couple of weeks that we haven't seen since COVID. Way more momentum than we saw in 2022, and about the same momentum as we saw in early 2018 when we jumped from a little bit lower levels than where we're at now to had a big 2-week jump well above the 200-week moving average, and pretty much changed the course for the rest of the next couple of years as the Fed eventually cut rates in 2019. Obviously, the Fed's expected to cut rates a lot sooner than that this year. All right, now let's talk about what's driving this price action. You can see, we're having a significant drop in international stocks over the past few weeks. I mean, really, since things peaked here, I think the NASDAQ peaked on July 10th. The S&P peaked on July 16th. So if I were to go from July 16th forward, so let's go July 17th. Now that's where the S&P peaked. It's down 8%. The Nasdaq's down 12%. IWM is down 10%. Commodities are down 5%. International equities are getting hammered, and bonds were down initially. Now they're up almost 5%. So big drop in bonds. In fact, the correlation with bonds and stocks are starting to shift. Remember how they've been positive for quite a while, especially if you take a look at the 3-month correlation. That correlation has been relatively positive because that's what happens in an inflationary situation. Bonds and stocks move together. But in a deflationary environment, they start to move in opposite directions. And that appears, so in other words, a falling yields environment. And that appears to be the case now. You can see we've one of our more negative correlations over a 2-week period than what we're seeing. And we've talked about when TLT makes a break above some important moving averages here, then things are going to change. Well, we're well above the 200-day moving average. And if I go back to the 200-week moving or the 50-week moving average, you can see last week's move there. When we start to fill in that gap between the 50 and the 200-week moving averages, then that's when we know things are ready to get going, and that appears to be the case. Like we are really starting to make a move to fill in that gap. Now we haven't had to fill in this gap because we haven't ever been this far below. The 50-day moving average has never been this far below, and now we're getting some positive momentum. So some significant changes, and that's what you're seeing with the 10-year yield, right? The 10-year yield is dropping down, now down to 3.78%. Way down here, off of its lows, but still way down below the lows that we had at the end of 2023 when the markets were really bullish because yields were falling. Now yields are falling, but the markets are really bearish. In fact, when you look at all the yields across the curve here, you can see that they're all starting to fall pretty significantly. Even for the first time, really, these two are starting to fall. The short-term yields, the 3-month yield and the 6-month yield, are all starting to fall. This is as of April the 1st. So it's not even including the last couple of days that we just don't quite see yet on this chart. If you were to take a look at this chart that we have, where we do have it updated, it'd be right here. The two-year has dropped below 4%, right? That's a significant level that we haven't seen it drop below for a while. This even during 2023 it didn't drop below 4%. It did a little bit at the end of 2023, early 24. But the big change since I've been gone is the drop in the 3-month. It was flirting with 5% earlier here today. You can see if I were to take a look at today, and we don't have it up today. Well, it's up to 5.19, so it's not quite on the chart, and it will be up here tomorrow. But we were flirting with the 5% mark and dropping. That's pretty significant because remember, this is the effective Fed funds rate. So once this starts dropping, then we are set up for a rate cut, right? And it hadn't dropped at all until just now. So now the bond market's finally saying, okay, we are going to get these rate cuts. And as we said before, getting rate cuts is not generally bullish for the markets. And as we're expected now to get, we have a 86% chance of getting 50 basis point cut in September. And then you're looking at, by the end of the year, looking at about 100 basis points of cuts at a 95% chance of 100 basis points by the end of the year. So just like that, we've gone from where we didn't have very high probability. In fact, in May, you can see the probability of no cuts at all was at 20% on May 20, whatever that was, May 28th, or excuse me, it'd be May 29th. 21% chance of no cuts at all, and about a 63% chance of only one by the end of the year. From May 29th until now, you can see now things have dropped pretty dramatically. As, like I said, 100%, pretty much close to 100% chance of 100 basis points of cuts. So pretty drastic change, and you see what that's the impact that's having on risk appetite just in general. Of course, the biggest driver for that is what's going on with the Japanese yen. Japanese yen was actually higher today, but that hasn't been the case. If I were to go back, it was down here today. But you can see for the most part, since the NASDAQ peaked on July 10th, that's when the US yen pair bottomed. So from that July 11th period going forward, so since the period that the NASDAQ peaked, the yen is now up 10% against the US dollar. The franc, which is the safety trade for the European currencies, it's up 5% against the US dollar. The euro has been flat for the most part. The pound has been flat. Now the pound is actually down against the dollar, and the euro's up 1%. So the dollar's down against the euro and the yen. In fact, if you look at, which are the two biggest components of the dollar index, when you look at the dollar index here, you can see the drop that it's had, mainly again because of what's going on against the yen more than anything, but also to a little degree what's going on against the euro. And obviously it's actually up against everything else. It's up against, it's up 8% against the Mexican peso. It's up over 1% against the Canadian dollar. It's up 0.5% against the pound, and it's up against all these other commodity currencies because again, commodities haven't been doing very well. That's been the other kind of major storyline is commodity prices have been also falling. You can see breaking below the 200-day moving average, breaking the new 52-week lows earlier today on DBC. And if I look at the weekly version of this, breaking below the 200-week moving average, which is again not something we want to see when commodities are breaking long-term moving averages, because again that's a sign that they're not in demand. And if they're not in demand, that means economies aren't growing, right? Growing economies are fueled by commodities, and rising generally coincide with rising commodity prices. That's kind of how that's a typical positive relationship between those two things. Let's take a look now at the sector rotation. So let me pull up these sectors here. See how everything has been dropping again, especially since that July 11th time frame when from this time forward, the Nasdaq, remember, was the one that started to break down first. You only have two sectors from that period that are underperforming the market. That's XLK and XLY. XLC is kind of matching, but I mean, those are your big three right there. And then you can see utilities and real estate benefiting from falling yields. Staples and healthcare are also up since that time frame. So you can see, which sectors are doing well. In fact, when you look at the sector rotation here, so bear with me 1 second. Pull up the sector rotation chart. You can see XLU, XLRE, XLV, XLP. Staples, healthcare, and utilities have the highest momentum right now. And then real estate, utilities, and healthcare barely has the highest relative strength right now. So they're the furthest to the right. So you can kind of see an XLK and XLY are the only two currency or sectors in the lagging category. XLC is actually improving, and XLE, interestingly enough, is not. So we are clearly moving into a safety trade. You can see here real estate, healthcare is moving up. Utilities was in the leading category with that AI trade. They've rebounded and moving up, and then Staples is just a smidgen away from being in the improving category as well. So you can see the change away from cyclical into kind of your non-cyclical areas, your interest rate sensitive areas, benefiting from the falling yields. Pretty significant breadth or bad breadth that we've seen. Number of stocks above the 50-day moving average breaking below the 50% mark. So still kind of in this neutral area, but in the lower half of the chart. So definitely not bullish anymore. Well below its moving average. Its moving average had gotten all the way up to 323. So it finally broke. See, we hadn't had that break for the most of the time that I was gone. So it wasn't until these last couple of days here, August 2nd and 5th, that we finally broke below the moving average there. And that's generally when we break down, is when that breaks below there. And we're still not even like extreme, as you can see. The number of new highs and new lows has dropped to a very significant level. Again, not a level that you typically see during normal pullbacks. So a big drop there in new highs and new lows. The ratio of the number of stocks above their below the 15 and below the 200, above the 15, above the 200, you can see has jumped up above its moving average. Again, that's typically bearish when it does that. It hasn't gotten up to an extreme yet. Hasn't gotten up to 2 or anything higher than there. So we haven't gotten to an extreme yet on that. And if you look at the McClellan oscillator, let's take a look at the McClellan oscillator here. You can see that we were flirting with 500 because we weren't too bad on the bad breadth until today. Today's our first day where we dropped below the -35 level, and we're still up pretty high. So, again, if you look back over here, we were just barely above 100 in early 2022 before we finally broke down with some bad breadth, and we'll see if that ends up being the case here if we end up breaking below 0. Which means again that we may just be in the kind of some beginning stages of more than just a pullback, more of a correction stage with all the technical signals that suggest we're in a correction that I've showed you earlier in the video. All right, now let's take a look at our trade idea of the day. I want to take a look at Toll Brothers. Toll Brothers, you can see, had been pretty bullish again all the way up to the last few days. Where now finally the intermediate line has dropped out of the upper reversal zone, but still in bullish territory. The near-term line dropped down to bearish levels, but not extreme. The obviously market sentiment line is rising there. You have light pink shading. We did not close below the moving average, so we don't have the yellow line. If you take a look at the weekly chart, we have gone bearish on the weekly Hakinyashi candle, but still no red arrow with the 10-week moving average. It's not that big of a bearish candle, again, like we saw on the S&P 500. Obviously, we did have 3 red arrows at the lows of the day today, but now we only have the 2 now that we closed there. So again, we don't have pink shading yet. We just don't have the green shading either. You can see when you look at the 2-line version of these charts, that you're sitting right on the 30-50-day moving average. You can see while there's a little bit of support there. There's also It's not the point of control for the past year, but it is the point of control for the past 6 months or so. As you can see, it will be the point of control here in about another month. Once we move some of this volume over here off the chart as we rotate over. When you look at some of these oscillators, we'll start off with the DMI first. Again, it was pretty strongly bullish, and now it's kind of bearish, right? But nothing too major, no significant change. You'll see the same thing in the RSI and the CCI. We're below 50, but not in bearish territory. We're below minus 100, but we didn't get below minus 150 or minus 200. When you look at the Ichimoku cloud, we are sitting on the cloud, just sitting right at that blue line. We still have a intermediate trend strength going there, though it's most likely going to end here pretty soon. If you look at the Bollinger Bands and the Keltner channels, you can see we've had a very strong bandwidth on the rally to the upside, and now that bandwidth is falling as we go into earnings, with some very strong momentum that also appears to be peaking. So it looks like we're kind of going sideways here, and with earnings announcement coming up, we can probably take advantage of that. We'll sell that 145 strike, which is where the recent highs are, happens to be right around the mid 20s, and then we'll go over here to the low 20s and sell the 110, 105. That gives me this pattern here, and you can see where my break-evens are. Here, let me throw those break-evens, throw these slices to break-even, and then we'll throw those slices onto the chart. And let's go back to the regular chart here. And you can see, okay, now, you know, we're, as long as we stay above the 200-day moving average or above that lower break-even, and as long as we stay below recent highs, we're below the top break-even, which is kind of what we like to see. And we got a smaller position size than normal because of the extra risk associated with the earnings event. We got a pretty decent return, again, for a lot less risk than what we normally take. We normally take about $1,000 of risk, but again, it's less risk because of the earnings announcement that's coming up here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping up in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.